Welcome to Wealth Coffee Chats, folks, for your daily live updates. Get the most out of today's episode by participating in the chat. Make sure you ask some questions, be part of the conversation, have a bit of fun, grab a coffee or a tea, take some notes, and get ready to start your day, folks. Quick few housekeeping rules, though. No spamming, no advertising or self-promotion in the chat. That's not on. Be kind and respectful to everyone when participating. And most of all, have a good time. Real estate investing can be your biggest asset. It also can be your most expensive asset when it comes to getting it right or getting it wrong, folks. It can be time-consuming, stressful, and that's why here at Positive, we have what's called a 6-star team, a full-service team that provides integrated wealth and property investing solutions and services simply designed to help you progress towards your goal of passive income through your property portfolio, folks. Make sure you check out our other podcasts on the Positive Mentor Network. Not only is there Wealth Coffee Chats, there's the Urban Property Investor. Drops every Wednesday with straight talking investing strategies and lessons with Sam Saggers. Property Investor Tales. This is where our clients, you guys, share real life stories from property investing, hosted by some of our advisors and strategists. And that's done every fortnight, dropping every Monday. Wealth, Wine and Wisdom, folks, that debriefs the week that was in the world of finance and property, hosted by yours truly, Jason Witten and Andy Fenton on Fridays. Hey, good morning, folks.
Good morning, everybody. Welcome to another Wealth Coffee Chat.
Hope you're well, folks, wherever you are.
There it is, team. Morning. Morning, wherever you're tuning in from today.
Early bird gets the worm, they say. Here at Positive, we offer a 6-star team. It's a team that help you at every stage of your wealth creation journey.
General advice disclaimer. The information and made available through this podcast does not constitute financial general nature only and does not take into account your individual objectives, a financial situation or needs. It should not be used, relied upon or treated as a substitute for specific professional advice. We recommend that you obtain your own independent professional advice before making any decision in relation to your particular requirements or circumstances. Positive Tax Solutions and its representatives do not warrant the accuracy, completeness, or currency of the information provided on and made available through this podcast.
Well, good morning, everyone. Welcome to Tax Tuesday, the second in a series on self-managed super funds. I want to welcome people coming in from apparently all over the planet. So good evening, Kevin in Lakeland, Florida. It's morning here. Interestingly, my wife and I owned a couple of investment properties in Lakeland, Florida, a couple of decades ago. So hi, know the area. Welcome. Okay, on with the content for today. So we spent some time a couple of weeks ago talking about the fundamentals of a self-managed super fund, and I wanted to go into the sorts of things you might invest in. Why would you set up an SMSF? What might you invest in? As a tax financial advisor, I'll give you a few ideas of things that I've seen. Now, this is not, we've given you a disclaimer, specific advice to you. I want you to check your own circumstances with a financial advisor before you do anything. But I'll share some experiences I've seen and some thoughts that I have on what you might invest in, things to watch out for, and so forth. So self-managed super fund, what do you see people investing in? Well, I see people setting up self-managed super funds to invest in things like cryptocurrency. Okay, so let's spend a little bit of time on that. First of all, cryptocurrencies, one thing they're not is currencies. They can be used as a medium for exchange, but there's a lot of speculation going on. What are they? I mean, Donald Trump has launched his own cryptocurrency. Whether that has value or not, I don't know. But basically, it's some technology. It can be launched by pretty much anyone. What's it backed by? Who knows? Is it a great idea? Absolutely. It's going to fundamentally change property transactions and banking. But the individual coins may or may not have inherent value. They go up and down based on what people think. And so I guess if you are going to invest in cryptocurrency, one of the thoughts I would have is only invest as much money as you're willing to lose. You can make a squillion. You can also lose a whole lot as well. treat it as it should be treated, something that is highly volatile, not in your control, and something that doesn't necessarily follow market fundamentals. Investing in the companies that are making the cryptocurrencies that they're selling to bank, the technology, that's a fairly straightforward play. The coins themselves, you need to be thoughtful as you invest. So only invest the money you're willing to lose. Of course, an SMSF is your choice of where you invest. And so long as you meet the sole purpose test of funding your retirement, you can invest in cryptocurrency. I do see people investing in shares. Now, when I think about a self-managed super fund or any investment, the types of things you invest in, they're going to perform their job of return, whatever owns them. And so the way to ensure that your outcome is better when you're investing in something that you don't fundamentally control is to pick the vehicle and the regime where costs and taxes are to your advantage. They're things that you can play with, manage, or control. And so when it comes to shares, I ask my clients to be quite simple and look at the numbers. A share portfolio that follows roughly the Australian Stock Exchange or anything else is a good thing to invest in. How you invest in and get a better return then depends on costs. So the competition in a self-managed super fund with Australian Super or Aware Super is quite tight. You can have a fairly big portfolio in Australian, and their costs tap out at around $3,000, a little bit more per account. You can also invest in places, again, without a self-managed super fund, places like Hub24, Net Wealth Premium, Macquarie Bank, where you can pick the individual investments in an account that's super, where they do all the work for you without having to set up your own SMSF. Their costs are a little bit higher, and per account, if you had, say, $250,000 in Hub24, that would cost you $1,500 to run. $750 would cost you $3,800. $1 million account would cost you $5,000 per account. Why am I giving you all this background? Well, a self-managed super fund kind of has some fixed costs, accounting and auditing, maybe some financial advice to go along with it. What that tends to mean is if costs are fixed in an SMSF versus in other accounts where the fees are based on the balance or a percentage of the balance, there's like a point where an SMSF is almost like a no-brainer. So if you've got yourself and your partner and you've got over $1 million in super together, it is possible that a self-managed super would be cheaper to run for the same investments in a share portfolio than two separate accounts of $500,000 each. And so at some point it becomes sensible, I guess, based on balance, to consider a self-managed super fund to invest in shares. Investing in shares with an account worth about $100,000, the costs of running the self-managed super will exceed what you could do in some of the other platforms. At about $1 million, it makes a difference. So the break even, whatever, would be in the high hundreds of thousands of dollars. You should consider doing that. Below that, it's probably not worth it. So for those of you who have SMSFs with low balance share investments, you might want to consider rolling that back into something that has lower costs so that you get a better return. Now, of course, what a lot of my clients do is invest in property. I just want to go over some details there. Again, good investment property in Australia is a good thing to invest in. Picking the right vehicle is key. And what I see people doing is not being able to borrow necessarily in their own name. They might buy in Super Next. That's appropriate, but what they don't do is run the numbers. So in a self-managed super fund, loans are commercial. The rates of interest at the moment, maybe you get high sixes, but I'm seeing, depending on the client, interest rates between 7 and 9%. Now that doesn't necessarily lead to super powered outcomes if you leave the loan around for a long time. So in a self-managed super fund, you don't control, again, what the property will do, or property will do what property is going to do. That's driven by the market. What you do control is your contributions and the loan you acquire and how quickly you can pay it off. And so as an example, if you buy $1 million property and it's a unit to a house and land, growing in an average year at 5 to 7%, that is creating $50,000 to $70,000 worth of wealth for you year in, year out. Yay, that's exactly what you want. Conversely, when you get the loan, if you haven't figured out how you're going to pay it off quickly, a 70% lend at $700,000, you might get that for 7.2%. That's going to set on fire or transfer to a bank's balance sheet $52,000 a year in cash. Now, tax rates in super are very low, 15% or 0% when you're retired. So there's not a lot of tax deductible help you're getting with that. If you go for a 0.8 or an 80% LVR lend, there's only one or two providers will give you that. They tend to charge higher rates. If you want to borrow a lot of money, you might be paying 8% for that. So if you've got a loan like that on $1 million property, the property might be making it 50 to 70 grand, but you're transferring $64,000 of that to a bank's balance sheet. That might be okay for a short period of time, but over the long term, what you're doing is having a brilliant asset, creating brilliant wealth, but you're giving that to the bank instead of keeping it. So here's some basic principles I recommend clients try and look at. If you're going to hold something in an SMSF or yourself for a full property cycle, 10 to 14 years, your property will double in value. Awesome. Again, that's what it's designed to do. So what you might want to do in a self-managed super fund is, can you pay off the loan in half a property cycle? Give the bank your money, your wealth creation for half the time. They did half the work. You leveraged up, right? That's a good thing to do with property. So transferring some of the wealth you're creating to them for their loan of your, lending you their money, that's a good idea. So you get a little bit, you get to keep the wealth over the full property cycle, and you get to pay interest only half of it. And what's really great about that is if you can, in the SMSF, pay off the loan in, say, 7 years, look at a loan repayment schedule, and you'll see the bulk of the interest is paid in the first half of the loan. That starts to look really savvy. Full property cycle of wealth creation, half of a quarter of the property cycle, you transferring an inordinate amount of the wealth you're creating to a bank's balance sheet. What that's doing is you're keeping wealth for 75% of the time, sharing 25% of the time with the bank that's helping you out. That is an almost assured, won't say guaranteed, way of creating a really powerful outcome in super. It's the loan you control. That's what you need to manage. That's what you need to model with your financial advisor to make sure that the investment you're doing in super is super powered. Now, the last thing I'll mention before we go today is business owners purchasing commercial property to run their business out of. Compelling, powerful way of supercharging your retirement. Why not double the value of your business? Increase the number of assets in your business, not just the business itself, but the premises it runs out of. That gives you a number of additional exit strategies you can look at for your business, and your business now funds your retirement instead of someone else's. That's a complex area of advice. It's a super powerful way of creating wealth for yourself and your family, and we will discuss that on another day. But for today, a few things to think about in terms of super funds. Speak to your advisor and your accountant. Make sure that when you set it up, you're doing it for your wealth creation, not theirs, because they charge you fees to set it up or run it. And of course, we're always happy to help clients with that. Okay, that's it for today. See you next time.
Thanks for watching another episode of Wealth Coffee Chat, folks. Make sure you like, subscribe, and turn on your notifications so you never miss a thing when we go live. Improve your portfolio and investing game, folks, with Wealth Coffee Chats live every morning at 8:10 each weekday. Make sure you join us. Previous episodes are also available wherever you get your podcasts, folks, as well as our other podcasts from the 6-Star team here at positivementor.com.au.